Welcome to Gagliardi Scott Real Estate Podcast, hosted by myself, Gerald Sabry, and Rocky Gagliardi. We look forward to bringing you something fresh, something new the Goulburn Valley hasn't seen before, more informative information. We've got special guests, hot topics. Make sure you follow on your preferred podcast platform, GSRE socials. We hope you enjoy this episode.
G'day all, Rocky here, Gagliardi Scott Real Estate, and thank you for joining us on another wonderful episode of our podcasts series. We've got two fantastic guests specialising in accounting and how tax and accounting relates to real estate and all your real estate needs, and I'm sure a lot of your mum and dads out there would be keen to listen to, get some tips and so forth, as well as all your commercial clients who are looking for investing into the marketplace. With me joins me Brian Thompson. Brian, welcome. And
Good
Adrian
morning,
Little.
Hey, Rocky.
How are you? Good.
Mm-hmm.
Brian, first you just introduce yourself, a bit about yourself, your expertise, your company you represent, so the audience know who you are. And
Yeah, thanks, Rocky. Well, Lou Purter and I created Purter Thompson Partners just shy of 20 years ago. So since then, we've grown into 4 offices, one up in Cobram, one in Shepparton, of course, our main office, down in Melbourne and Geelong. And over that time, I suppose we've really just specialised helping clients, and our tagline is creating dreams worth fighting for, and really just trying to get to where it is they want to be. And so obviously we do the accounting, the compliance, wealth creation, advisory, bookkeeping, all the things that, well, to put it quite simply, are just to help them get from A to B.
Yep.
And it's not just about them, but the team as well.
very good. Adrian?
I'm a director at MB&M, another local accounting and financial planning firm. We've got a team of 50 and specialising in your business needs, tax compliance, advice, wealth creation, retirement planning, Centrelink, all that type of thing as well.
The biggest topic I come across when it comes to real estate, and obviously we deal with mum and dads every day, or people looking to get in the marketplace. A lot of the questions surrounds capital gains. Not everyone understands it quite well, but maybe Adrian, run us through what the simple, basic capital gains and how it affects, and obviously the benefits and not benefits, and when you should utilise it, when you shouldn't. Go for it.
Yeah. So simply, capital gains is obviously what you sell for, deduct what you bought it for, and you've got your capital gain. There's some adjustments that you make along the way for other expenses you might have incurred. So that will give you your capital gain. Generally, mum and dad, if you've owned it for over 12 months, then you'll get a 50% discount on that. So if you've got a $100,000 gain, you'll pay tax on $50,000 of that capital gain, essentially. Yeah.
So Brian, I had a call the other day from a lady who was looking to sell her property. Her and her brother were together in her property, and he's retiring next year. She's a pensioner, sort of relying on benefits, and they've inherited the family home, but obviously a certain time they've got a capital gains issue. And I'm not an accountant, but I was just giving her my advice. I said, bring an accountant, whatever you do, but I don't know if you're going to be that affected because your income's not that great. So that 50% that Adrian hit on, say you've got your 50% discount, but you have got 50% you still got to claim. How would that affect someone who's on a low income compared to someone who's on a high income? Can you? I suppose what I'm trying to get to is, can you write that off too instead of being affected totally, pay 50% off?
Yeah, look, that's a fairly lengthy question there, Rocky, with a lot of angles in it.
Possibly, just pick a couple angles.
And it is tricky because on part of that we start talking about a low income and maybe some Centrelink benefits as a result.
That's right.
So Centrelink treat these things differently to the tax office. So it's actually different things we end up looking at. So at the end of the day, from the tax point, like Adrian said, there's a certain amount that's non-taxable, which disappears. But on the Centrelink side, it's that whole wad of money that comes in will get counted as an asset.
Yep.
And they will obviously be tested on the assets test or income test, really depending on what kind of payment they're on.
Yep.
So it is always tricky to try and assume what might happen there. If there's a split between her and her brother, I think you mentioned, that could be helping to keep the income lower.
Yeah.
But it could just be that they end up getting reduced Centrelink payments and maybe possibly not even pay too much tax because they are on a low income.
Yeah.
By the time they split that capital gain in two, and it might only be 20,000
Yeah.
to one person, if they've got no real other income, they could be non-taxable.
Yeah.
But there's obviously some settling comes into play. But in all those, it is, you're right, Rocky, it's call the accountant,
Always, yeah.
gather some data,
Yeah.
and try and make some assessments and
Yeah,
decisions.
because they're always talking to their neighbour or their best mate or someone. They're always giving advice. We're the same in our industry, you know. But the basic point is, after you own it for 12 months, it's a 50%, so you don't get taxed on 50%. That's
Yep.
But if you sell before the 12 months, let's be important about that.
Yep.
You're going to get taxed on the whole 100%.
Absolutely.
Is that correct? Yeah. So that's important
Yep.
for the audience to know that
Yep.
you sell it within 12 months. And then, I suppose, leading into that, when is it defined, that 12 months? Is it? That's a big question I've fought with accountants compared to lawyers and so forth. My understanding is when someone signs a contract, an exchange is unconditionally, not the settlement, which is completely different. That's when the tax office looks at it. Is that right?
That's my understanding as well, Rocky. In 99%
Yep.
of the occasions, you can go with that it is just the signing of the contract,
Yep.
nothing to do with settlement.
Yeah, so we explain the settlement. So if I come to you, Adrian, got a contract, signed, exchanged it. Now, is it unconditional or is it just when it's exchanged?
Just when it's signed.
It's just when it's
Yep.
signed, even so, not even the conditions or becomes right
No.
because the tax office then. Yeah, so that's interesting, you know, how that works. Because I don't think the common person or the layman out there doesn't understand that. Like, I think it's, I got a settlement this date,
Absolutely.
and that's it. And it's no, it doesn't work that way. So that's important.
Common discussion with clients, isn't it?
Very
Yeah.
much so, because it is that when you're asking a client, now, when did that sell?
Yeah.
They're thinking, when did I get the money?
Correct.
It sold next year or last year, and you get a contract, and all of a sudden, no, it didn't work that way,
Yep.
and all the numbers change.
Yes.
So it's always collect the data, which generally isn't just a conversation with a client. That gives you where you want to chase the formal documentation from solicitors or whoever's got it.
Yeah, because not many people realise it's a tax office that constitute a contract signing is the legal sale of the property, not the settlement.
Yes. Yeah.
Adrian, mum and dad buy an investment property. What are the depreciations that people use? You always hear about depreciation, and you know, or they buy something or look at buying something and they go, "Oh, my accountant's asked to, you know, we need to depreciation list or whatever."
Yep.
Talk us through that and how that benefits a potential investor in a marketplace when they buy an investment property.
Yeah, absolutely. So I think we're going to say this a lot. It's good to talk to your accountant and work out whether it's
definitely.
actually going to benefit you to get the depreciation schedule, because they can be costly to go out and get one done. But basically, if your property is a new property, then you'd want to go and have a look at that, and it will split your property essentially up into two aspects. One, which is your capital works, which is your house, any renovations that were done, the build costs, and then you've got your plant and equipment on the property. So the dishwasher, the curtains, that type of thing that can be removed from the property easily, and it will split up the depreciation and the relevant rates for you.
Yeah.
But definitely need to talk to your accountant and work out, is it going to be worth me getting this done?
Yeah, so walk me through that, Brian. How would that be worth someone to do that? Well, if I was to buy an investment property, why would it be worth me to get that depreciation, or why wouldn't it be worth me, I suppose, is the other question.
Yeah, so depreciation's a good one, Rocky, because it's a deduction that you're not physically handing out cash for, like when we talk about rents or repairs. The cash we've paid is when we bought the property itself, which we can't write off. So we look for depreciation. So in the building depreciation write-off, there could be 40 years worth of depreciation for the building and the property.
There you go.
So, and that's whether it's second hand or not. So the newer the property, as Adrian said, the more likely there's some good deductions in that. So you want to go to a quantity surveyor. There's a number of reputable ones out there, and get that report, which then we can rely on in the case of an audit. The ATO
Yeah.
will use those as well.
Yeah.
But yeah, that depreciation is just something you're going to claim every year that I'm not physically handing out money for. So it helps me with my tax refund or
Yeah,
reducing
that's
the
more-
amount of tax that I pay.
Yeah, that's the key thing here
Yes.
to the person. It helps with their tax, so they're paying less tax.
Absolutely.
So it is important to talk to your accountant and make sure if you're involved, you can get that tax depreciation, because I don't think a lot of investors out there do it. And, you know, unless they come and see you and do tax time, they probably missed a couple of years or a year's worth. A lot of them, you know, don't actually do their taxes or do it themselves at home, whatever. So it makes it very difficult to claim those situations. All right, so I'm buying an investment property. I ring you and I'm asking you, I need to put it, Adrian, what name do I put it in?
Yep.
Because it could be my personal name.
All those simple questions.
Yeah.
Yep.
A lot of tricky ones that I get every day.
Yep. Probably the two most common one is your individual name or in a partnership with your husband, your wife, someone like that. And then there's your family trust that people tend to invest through as well. Bit of a difference with the family trust. If you're investing in your individual name and you're negatively gearing it, so you've got a loan against the property, say, then you can claim that loss in your individual names. If you invest it through a family trust, then the losses can't be distributed. Yeah. So it kind of quarantines that loss in the family trust. Family trusts have other benefits with asset protection and tax planning strategies, investment planning, estate planning as well. So all of that can outweigh the benefits of being in the individual name. But again,
talk to your cat.
No
personal situation definitely depends on a bit.
And it's very tricky with that, isn't it, Adrian? Because it's the life cycle of the asset itself. So it can go from I'd like to have it in the wife's name for the first 10 years, then maybe the husband's for the next 10. But it'd be great if it was in a family trust for the last 10. So you're really trying to decide from there. And so it's those discussions that try to find out, well, what are you going to do with this property in the long term?
That's a good conversation to have at the start. So Adrian, you touched on a bit of on the other questions that I get alluded to every day, which was good. No, that's good. People don't understand, a lot of people don't understand what negative gearing and positive gearing is. And here, when you're talking out there in the politics, and I think when Shorten went to his election, it was a bit of a big topic then, and so forth. Go through what negative gearing and positive gearing is, and for the client, I know it's a simple one, but not everyone gets it.
Yep. So negatively gearing would be when you've purchased a property, you're renting it out, but the deductions that you're not the expenses, because your loan repayments aren't an expense, but the tax deductions that you're paying out for are more than the rent that you're receiving in, essentially. Positive gearing is when they're not higher, when the income's higher. The negative gearing is generally looked at to be quite a tax advantage, because it obviously reduces that taxable income that people have and gets them that higher refund at the end of the day.
So that's just on the interest side, not the principal, or on the loan, is that right?
Correct. The principal of the loan is just a repayment there, so it's only the interest that's tax deductible.
I do a lot in commercial real estate, and that this doesn't mean, I think residential clients as well, mum and dad's, it's important, this, but I don't think a lot of clients out there realise how underutilised their super funds are, and what their savings are, and in their accounts, and how they can actually utilise it. A lot of people just think it's sitting there, when I retire I'm going to grab it. But it actually can do a lot more than that, am I right? In the sense of saying that, if you've got 200 grand in your bank, for example, saved between you and your wife or partner, what's the best way to utilise that? Can you borrow against that, or can you buy something with that? What do you need to do to get to that next stage, Brian? Like to actually utilise that money that's sitting there?
No, you're correct, Rocky. A lot of people don't look at superannuation and think that it's an asset as such. It's just something that we call superannuation, and it goes up and down. And at times we're happy with it, and at times we're not. But when we really drill down and we look at the use of, say, a self-managed superannuation fund, that's when you can move money across from a retail fund, have it in a self-managed super fund, and you can essentially have more control on it. So you could go and buy a commercial property or a residential property. Lots of rules around this. It's not that straightforward, but you can go and own that property. As many investors are bricks and mortar type people, they feel comfortable in that versus it being in a share market or a managed fund or treasury bonds or a term deposit, that sort of thing. They like their bricks and mortar. So it gives them the ability to use that super that they've been saving up to put towards retirement to actually invest in a property that hopefully then will also work towards their retirement. But yes, just mindful that there's a lot of rules around it, but superannuation funds can certainly be used to buy property. And they can be used to borrow to buy property as well. But once again, it's not as straightforward. I'll let Adrian talk about the costs of putting all those together. But it's certainly something that when it first came out, 15 years ago, it was really exciting for everyone and super funds took off. These days, because of the complexity, the compliance, the cost, there's probably not as many happening in that space.
Yeah.
So still a few, but yes, certainly worthwhile if people do like property, especially related to your business, that kind of thing.
Yeah.
A good way to get in and buy good investments to work for your future retirement.
Yeah, it's interesting the rules, Adrian, on borrowing on super. I have a lot of commercial clients that they don't get this, but the super funds aren't allowed to borrow on buying just a block of land, vacant land, and then the bill.
Yep.
They won't allow that.
Yep.
Am I right in saying that? So,
Yeah.
but what they can do is buy an existing property. Is that right?
They can.
Can they do that?
Yep. You can't alter what you're purchasing,
Yeah.
essentially.
Right. That's the key.
That's the key.
That's the key.
Yep.
Right. The altar.
It's probably also important to note that there's actually not that many people out there, lenders, who will lend you the money
Right.
to borrow in your super fund anymore. So the big four banks, they don't offer it.
Really?
So it's actually, and because of the risk associated with it for the lenders, a lot of the banks have just canned it. And those who do offer it, it's quite a high interest rate.
Yeah.
Yep.
Interesting, because I find a lot of clients that are looking to get into, especially business clients who got their business, let's hypothetically, a shed, a mechanic. He's got 300,000 in his super fund. He's paying $50,000 a year in rent. He's thinking, this is killing me, but I'm getting through. I could pay myself that year, but I can't, I can't borrow, but I got $300,000.
Yep.
If I had $300,000 in savings, can I put them together? And can I buy a $900,000 shed and borrow, or how can we do
There's
that?
different ways you can structure it,
Yeah.
certainly, with trusts that you can have super funds owning part and other entities owning part as well. That's a very big conversation and a lot of planning going into that.
It takes a
Yep,
long time, I get that.
absolutely.
Yeah.
Yeah. And then you can obviously look at contributions into your super fund and maximising things as well when you've got money outside to help that.
Yeah, I find I've sort of, my advice is to my clients, go and talk to your accountant or go and talk to a broker or whoever's specialised in it.
Yep.
And see what you can go, because it's untapped really how much you can utilise, because if they can pay that $50,000 to themselves and they work for another 20 years in the business, they sell the business and they've got this shed or whatever that is their own asset, and they can then rent it out themselves and they've owned it. So it's a big heads up.
Yep.
Yeah. I don't know what else you could both share with me as far as what do you come across the most as far as your clients when you come and talk tax time, or what questions do you get the most, Brian, from a client that rings you, especially business clients maybe?
Yeah, well, I was probably going to talk about whether they're business clients or not. You quite often, people love subdividing
Yes,
these days.
that's good.
So they'll have their home and they'll subdivide the back block off or something like that and sell it, and always be using that. Well, it's part of my home, so it's no tax to pay, capital
that's a
gains
good
tax
point.
free.
Yeah.
So you see those sort of things happen quite often, and it's quite disappointing to have to deliver the news that there's a tax bill associated, because it's just, they can't understand that it's not my home. So when you cut it off the back and there's nothing on there, it is just a vacant bit of property.
Yeah.
So there's no capital gains tax, principal place of residence.
Yes.
So those are the little things
Yeah.
that you run into quite often, and unfortunately a lot of the time, and I'm sure you experience this, Adrian, is that you're finding out after the fact, and just the smallest amount of planning beforehand
Yeah.
would have changed the whole tax outcome altogether, or put a plan in that kept a lot more of the money back in their
Yeah.
pocket.
Yeah.
Because when we do those things, we've generally on-sold what we wanted to do with that money.
Yes.
So all their future plans start unravelling very quickly as well.
Because I get that a lot. People, I'll subdivide the back off, and probably elaborate more on what you just mentioned. Then is the principal place of your home.
Yes.
They think it's not taxable, but when you get to that stage, it actually becomes a development site pretty much, and that's called business. Or is that what the ATO?
Well, yeah, that's, once again, there's some thresholds you can step over that do take you into a business world. And
Yeah.
so therefore we're not even talking about capital gains anymore.
Yeah.
We're talking about normal income. And I suppose just on that, capital gains, when we have a capital gains,
Yeah.
it ends up being added to our taxable income and taxed at whatever the marginal rate is. So that can push it up and down, but we do generally get that 50% discount, which means there's a lot that doesn't go there.
Yeah.
But once it's just income, it's just straight into your tax return. there's none of the discounting, and it doesn't get those favourable concessions. So it just causes a lot more tax to be paid.
Yeah.
But if we move into that business development, all of a sudden GST raises its head as well.
Yes.
And more further complications come into it. So once again, it always still keeps coming back to you've got a great idea, your accountant is the best person to go and throw that one past versus somebody at the barbecue that you've seen do a development at some stage.
And that's the biggest problem we find. Like, we're almost in the middle of everything. They've finished a barbecue with their mate. They've told me this. Or they've gone for a Christmas break with their family. Someone's over the kitchen table has mentioned an idea. They've rang us up on the next day after Boxing Day, not waiting. Can't wait any longer to. And I'll go, well, ring your accountant or ring your solicitor or whatever. So you get that a lot with the GST factor and how that impacts real estate. Just go through that, Adrian, about how a property attracts GST and how it doesn't attract GST, and if you're a business as well, how that impacts businesses as well with their GST and their collections and so forth.
So there's certain properties that can be sold as going concerns.
Yep.
We've obviously got subdivisions that are included in that. There's different rules for every property, basically, every type. You've got your agricultural land, there's a different rule around that too. All to do with GST. And a lot of it comes down to the contract, the purchase, the sale, and what's happened in between with your GST registrations and so forth as well, which can impact things too. You might have recently had someone who was selling a property. They'd been registered for GST the whole way through, and all of a sudden the purchaser, they'd agreed on a price, and by the time that got to me, I said, well, you have to pay GST on this.
Yeah.
And the purchaser's not going to want to up it their price 10% now because you've already agreed on it. So, that's
important, that part of it, because they get to a contract stage and they do agree to a price and, they don't talk to their accountant or the solicitor. And this is the problem with not getting that advice before you do something. You come up with a price of 300, for example, on a property, and it does attract GST, and you go to contract stage. You hope for the solicitor, but the problem is you've lost a sale. Because I haven't marketed it. I mean, I tried to do my research before, but you haven't marketed exclusive GST. And further to that is just stamp duty on the GST. So purchasers got to, a lot of people don't understand this, but it's not only stamp duty on the 300, for example, but the stamp duty on the 30 grand or whatever. But can they reclaim it back, the purchaser, if they had to pay plus GST?
Only if they're registered.
Only if they're registered.
Yeah.
So what's tell me the minefield? Is it too late after you've purchased, Brian, to register for GST?
Well, no, it's not actually too late to register. You can backdate a registration, but it's also got to then meet the rules of you being able to claim the GST.
Yes.
It's got to be the correct acquisition type. So that's not always the same for a seller, a vendor, and a purchaser. So that's where, once again, it gets a little bit tricky. Yeah. It's the data determines it, and then sometimes they might want to claim that back, but that then hurts the plans of what they wanted to do with that building.
Yeah.
So it's a double-edged sword because sometimes the bird in the hand isn't as good as what you could get for it later on type thing.
Touched on before, a going concern. A lot of people don't understand when I talk to them what a going concern is. I still get commercial clients go, "What are you talking about? I've got to pay GST or whatever, and I've got a tenant in there, or there's a business running out of it." So just explain that, Adrian, what a going concern actually is. How's it identified by the tax office, I suppose, and how they see it?
Every time I talk about this.
I can see you grimacing. Cringing about it.
It's complicated, basically. So you do. I need to refresh on the rules before I go too far into it every time. If you have a property that you're registered for GST and you're selling that as a business property and it's going to continue as a business property, then you can potentially tick the box on going concern, and we don't need to worry about the GST side of things on that. Simply,
Exactly.
Trying to simplify it down.
You need to, but a lot of people don't get that part of it.
No, and it's the same for businesses, that kind of thing. Like it is, we always go back to pull the sheet out and it's like a checklist. Is there this, is there this? Because it only takes one of those things to be missing and all of a sudden it's not a going concern. So we tend to never go off our memories of what we think the rules are in those spaces because it's just the finger gets pointed back at us if it doesn't work out
Oh,
the
of
right
course.
way. So
Absolutely.
it is something that is important, especially when you talk about commercial properties and it's like, oh, it's great, it's got no one in there, it's vacant possession.
Yeah.
But all of a sudden, as you say, we're spending all this money on stamp duty, and we've got GST on the stamp duty now as well, which is lost money,
Yeah.
essentially.
So if agricultural land, and say I've got a 20-acre orchard, is that a going concern if I sell that business?
If you're selling it as an orchard,
Yeah, as an
and
orchard.
it's going to continue as the orchard.
Yeah.
If you're selling it as an orchard, but it's going to continue, you know, they're buying it to develop it and subdivide it,
Yeah, that's different.
that's different.
Yeah, so if I'm smart enough, I bought the orchard, I'd continue to run it for how long can I run it for? I suppose how long is a piece of string? It is a minefield, isn't it, really? Like, and it
Yep.
sort of reinforces a little bit about, you know, if it's a minefield for you both,
Absolutely.
how can the person in the street get it? Like,
Yep.
so it's really important to go back and talk to your accountant and go,
Yep.
go for it.
Can't stress that enough, Rocky, because at the end of the day, even a lot of what we do, well, the ATO is taking lots of people to court over these things all the time, and they probably only get it right half the time and get it wrong half the time. So
Yeah.
the rules constantly change every time a new court ruling comes out,
Yeah.
and it's just
That's
wow.
the big thing, isn't it?
Yeah.
Your mate at the barbecue might have done something 5 years ago, but there's been 10 court cases since, and the rules have changed now.
Yeah,
Yep.
and that's the precedent. The
Yep.
people don't realise that the court case and the judge's understanding of it. Yeah, and obviously politics, and you know that changes, and different governments change, and it's really important to get your head around it. Hence why you've got to ring your accountant to find out. Adrian, what else do you come across mostly that you think, oh, I wish you know people knew more about this instead of ringing me all the time, or or you come across it's a common problem, I suppose, probably the better way of putting it.
Yeah, it's probably more superannuation funds investing in property,
Yeah.
just understanding the rules around that it can be a really great tool, really great investment vehicle. Super funds, you know, the maximum tax at the moment is 15%, and if you're in a pension phase, then it could be 0%. So
Yeah, okay.
those capital gains tax implications may not actually apply to you, all those types of things. But a lot of people purchase it thinking this is great, but they don't realise that the rules around super fund properties is that you have to pay market rent. You've got to get regular valuations. You have to pay the full amount of rent on time as though you were leasing it to someone else or leasing it from someone else. That's probably...
And why is that? Because that's important. Why, I'm buying my premises to work out of,
Yeah.
or whatever. Why is it important? Why can't I just give myself a discount?
Yeah,
Why can't I
be-
just pay 15,000 instead of 30,000 a year?
Yep. So the end rule for superannuation
Yes.
is that is there for your retirement. So it is there to provide for your retirement.
Yeah.
It's not there to provide for your business right now.
Yes.
It's there to provide for your retirement. So it's all about getting money in it and making sure that your growth and your income, your return, is there for the retirement rather than
Not trying to rip you.
the here and now.
Stop you from ripping yourself
Yeah.
off in your future.
The easiest way to think about it, Rocky, is it is two separate people.
Yes.
And you think about it, if I'm not getting paid and it was somebody else in there, wouldn't I be chasing him for that money?
Exactly.
Well, that's what you
Yeah.
should be doing for
Yeah.
yourself, no discounts. And that's why we do have all these laws, is to protect, I suppose, the integrity of the superannuation system, to make sure not too much discounting and everything
Yep.
else goes on.
Yeah.
And as I said, the volumes of rules that just keep adding up
Change.
each year in that space makes it harder and harder. But
Yeah.
it is very difficult because you can go through tough times in your business and you are the landlord and my business is going down, not going very well. Can't I just skip rent for the month? Or what about another month?
Yeah.
That kind of thing. So
Yeah.
that's where it can
So
be
how do you
very
have a
sad.
negotiation with yourself? Listen, landlord, I'm in trouble. How does the tax office see that? They don't. They're not sympathetic as if you're renting your own from a different landlord.
No, they just look at it the same way to say, well, what should the super fund be doing as a landlord to recover that money? And they would go all the way to, are we trying to evict the tenant?
Yeah.
Are we trying to get them out of there, that kind of thing?
Yeah.
Yep.
Yeah. So you almost have to evict yourself.
Absolutely. As though you were someone else.
Yeah,
Yep.
yeah.
Absolutely.
Yeah, you
Renting
go.
a property from you.
And,
Yeah.
and we have an auditor come in at the end of the
Yep.
year
Yeah.
to ensure that we're doing these things.
Yeah,
and
yeah.
if we're not, then it's reported back to the ATO. there's fines and penalties. So all the things where you don't want them coming knocking on your door. So
Yeah, she's pretty strict, which is a good thing. I mean, you could take the mickey out of it, and all of a sudden you're in all sorts of trouble, and everyone can be.
Yeah.
Just on that, with the super funds, and we noticed it's coming with your super funds. How do you find that with the government changing their rules just recently, or announcing the next election potentially if they come in, that the $3 million threshold, if that's the tax brackets and that? How do you find that's going to impact it? How do you feel that's going to go in the future if that comes off? And I got the feeling that reading, it's not as simple as what it's made out to be. It's a bit more complicated. Am I wrong or right?
Definitely
You're
right
correct.
on that.
Any change in super is a lot more complicated than we ever read into it.
Yeah, so the feeling I'm getting is the common person on the street's going, I haven't got $3 million, doesn't worry me. Bugger the person who's got 300 million or 3 million, and then they've got that 300 million wouldn't be a problem, but I think someone with 758 million, no one else in the paper. I don't know how they got that, but
Exactly.
whatever it was. But they got 3 million. They can do it, but it's not as simple as that. I'm hearing, and it's going to be more complicated. I mean, I don't know if you can get your head around it, but is it true you got to come up with the stuff? The rule is you got to come up with the cash every year if your property. No.
At the moment, that's what the
They're saying.
ruling is suggesting. How that is actually going to come into place and how they're going to do that, I'm not sure. Because it's not on realised profit, it's actually on growth in the market. Yeah.
So we digress.
Still waiting for a lot for that to come out.
My understanding, this is just a conversation we're having now, so we don't know, but let me say a farmer's bought a property in their super fund for $100,000, and they're going to do valuations, and if it's worth now $3.5 million, and he's thinking he's sitting there worth it $1 million, and it's actually $3.5 million, he's got to pay 30% on that 500 potentially. Is that right? And that's 150,000 he's got to come up each year.
We'll go with your data, but yeah, they're talking about if we do the unrealised, then yes, there's a tax bill that's going to be there.
And he's got to come up with that money every year.
Way I understand it is you'd only come up with the money on the growth every year.
On the growth.
So you realise it to a certain value, and then next year it starts at that value and goes up to whatever the next valuation is. But
because it almost makes it not worth owning the property because you're paying it off. It actually makes it negative, really, doesn't it?
Well, it's a really ugly one, that one, and I'm not sure whether it's just one of their claims that is right out there on the spectrum so that any other changes they make don't look so bad.
Yeah, they adjust it back.
And at the end of the day, they're looking for that, what's taken 20, 25 years, they're getting closer to trying to find this middle gap of saying, we want you to have this much, but we don't want you to have too much more than that. But at the end of the day, we want people to be able to look after themselves in retirement versus being on the government system.
Not tax grab, boy.
No, that's not the words I would use there.
No, right, not really diving in and helping the budget, is that right?
But no, it is interesting. A lot of these major changes do happen when the budget is under a lot of pressure.
Yes,
So,
and it's not there for our benefit, I don't think. Windfall tax. We've got some dramas coming up with this windfall tax, I can tell you. Not many people understand that, but a lot of developers got their head around it, and even then they still haven't got their head around it with the rules. And have you got your head around it?
Look, I actually I looked this one up this morning.
You got to bring it up?
Because I thought, well, this is one of those big sleepers, and I haven't followed it for some time.
Yes.
Because they have been talking about this for a long, long time, and it's just been put off for year after year. But my understanding is 1st of July 2023 it does come into play.
Right.
And it is that part of really, in the simple format, same thing. If your land gets rezoned, let's call it farming land, and it was 1 million and it's now worth 5 million because it got rezoned to be able to go into housing blocks, then there's a $4 million windfall gain, of which the government's saying, well, you should be contributing back to the government coffers for that, to the community, that kind of thing.
Because we help you rezone it.
And I think the latest numbers around that is, so 50% of that 4 million, so a 2 million gain, and they'd want 50% of that.
That sounds,
Was it about that?
Yep, my understanding.
So
Or
2 million or 1 million?
No, they'd want 50% of the total gain.
The
so
total
they'd
gain.
want 2 million in
Yes.
tax,
Yes.
and you can keep the other 2. but they're not making you pay for it straight away. You can elect to defer that until such time as you start selling those properties. But the thing I didn't read previously is they will be charging you interest on the way through on that,
That's the problem.
and that's the problem.
So what if I own that land, Adrian, and it gets revalued and rezoned, and I don't want to develop it, I want to farm it? How does that impact it? Or does it?
I think it comes back to what you're actually using it for again.
Is that right?
As opposed to, I think you would have to go through a process of proving that, though, I believe.
Right. So there's a bit of work.
Yeah, yeah. Not as straightforward as just saying I'm going to farm it. There's proof that needs to come into that you'll have to provide and get an exemption from it.
And it's pretty tricky, Rocky. Once again, the rules, and they'll be once they bring this in, the amount of rules that happen out of a lot of discussions and arguments and things.
Yeah.
But in that sort of case, that 5 million example, you might want it actually to be classified and have that windfall tax gain or issue, because you might farm it for the next 10 or 15 years and then do something about, actually, I'm going to now develop this.
Yep.
Well, there's no extra windfall gain tax because that happened back at the rezoning time type thing.
So it's only at the rezoning time?
Yeah, so whilst you lost 2 million, in another 10 years' time and it's worth 20 million, the rezoning coming forward might have actually been a benefit for you.
So-
Not sure what the interest bill would look like at that time, though.
Pretty expensive interest bill if it happens to wait that time. But it's still, for the way I see it, it actually impacts the developer, not so much the land flipper, if that we can sort of say that. People buy the land, sit on it, and then flip it in 2 years' time, make some money on it. Because I think they'll be relatively stopping the market. It's not going to make much money, but the developer that buys it, it's almost directed at that, which shouldn't be. But the developer buys a land, that $5 million property that's only worth, they bought it for $2 million, whatever, that they're going to pass it on to the buyer that buys a block of land. They're not going to wear the cost. It's going to come across the
Absolutely.
line.
Yep.
On top of that, the way I see it also, is going to be less land to be developed because not many investors are going to go out there to do it and hold. What the common person doesn't understand is the holding costs of holding these stuff, and that it's just not going to work if it doesn't. So I just think prices are only going to go up, no matter how bad the economy gets. It's the blocks of land are going to go up, which is going to affect the building trade. I mean, there's a lot of connotations and so forth, but am I right or wrong, or your opinion?
I tend to agree that the costs overall will go up because they will want to try and recover some of it at least, because with any of these projects there's a risk evaluation that's done at the start, and if they can't get the right return as a bottom line, why would we take the risk of going into this? So when a tax will be factored into it to try and make sure that there's enough in it, because a lot of these developments take a long time, so they're at the mercy of the economy so
correct.
often.
I think the other thing is you regularly see properties that are sold with the subdivision, with the rezoning already done.
Yes.
That's not going to happen anymore, is it? If you're going through the hassle of rezoning, you want to get some benefit from.
Yeah, you're going to hold off.
Yep.
But then there is another aspect of it when the local councils will rezone land regardless of whether you want to or not.
Yep.
Which is what you said before.
Yeah, absolutely.
It's forced upon you.
Forced upon you. Then you've got to prove. That's where the extra stuff is in. You've got to spend money to prove that you're not actually developing it, but you've got to pay interest.
Or to work out the big picture plan. What is the plan? Which is that can be some really tricky conversations in families, especially with farming families, where mum and dad are asking the kids, what's the plan? And sometimes the grandparents are asking the grandchildren, what's your plan? And it opens up a big can of worms with.
I suppose one thing today we've worked out is talk to your accountant before you do anything.
Most definitely, Rocky. Most definitely. It all revolves back around data and where you want to go to and what that looks like. And it seems so simple, but it's just one of those things that's not.
The world seems like it's getting more complicated as we get
Absolutely. And I think, Brian, you mentioned earlier, it's not just about the now planning, it's about the future as well. It's not just how we're going to do that so that it benefits you now in the best way, but if we do that now, how does that end up in 10, 15, 20 years' time for you?
Which is hard.
Yep.
Because how do you know? Things change, but Anyway,
And that's the unfortunate thing about a lot of the planning that goes on, Rocky, is we can plan as best as we can, but unfortunate events, a death,
Yeah.
those sorts of things, and especially when we talk about, say, self-managed super funds, and you've got that bit of real estate in there, and it was one big lumpy asset. So there's lots of liquidity issues, and everything else comes into play. So sometimes your best laid out plans can sort of fall apart right at the end.
yeah.
So yeah, it's a constant keep evolving and evaluating the plans and make sure everything's going
Yeah.
correctly.
Which is why the advice at the start is the best.
Yep.
And property's one of those things, isn't it? Some people look at it from the point of view of it's an investment, so I look at it as dollars and cents.
Yeah.
Others just fall in love with the property
Yes.
and have all these great ideas. So dollars and cents
Doesn't
don't
come into
really
it.
matter. So you've got to be able to cater for all the sides and still try and get to the right solution at the end of the day.
Very good. That was a really great session today. I think that was very informative. I think I'd like to thank you both for appearing today, and really, that was really good. So, if you're out there and you've got an accountant question, please call Brian and Adrian. Make sure you get your facts right before you actually commit to your next real estate transaction. Thanks for joining us, and we'll chat soon. Thanks for listening. Please subscribe on your favourite podcast platform so you don't miss upcoming episodes. We would love you to share this podcast with your network, and if you have any questions or feedback, please connect with us via our social network or head to gagliardiscott.com.au.